Hey everyone, welcome back to Corporate Decoder, the place where we decode the juicy secrets hidden in plain sight within corporate filings. Today we're diving deep into Blueport Acquisition Ltd's filing, and let me tell you, it is a real page turner, especially when it comes to understanding exactly what this company is up to. So, what is the big story here? Well, Blueport Acquisition Ltd is basically a company that exists to buy other companies. Think of it as a financial matchmaker for businesses. They had their big debut, their initial public offering or IPO, and this report tells us how they're doing right after that major event. First off, let's look at who owns what. As of late 2025, there were over 5.9 million Class A shares and nearly 1.5 million Class B shares. Now, Class B shares are usually held by the founders or early investors, and they often come with special voting rights. This gives us a hint about the control structure right from the start. Now, let's get to the real meat of it, the financial picture. This is where we see the company's financial health on the 30th of September 2025. Right away, we see a very small amount of cash, only $5,000. That might sound alarming, but for a company like this, which is essentially a shell waiting to acquire something, this isn't unusual. Much of their money is likely tied up in special accounts. On the flip side, their total short-term debts, what they owe soon, are over $236,000. This includes money owed to related parties and a promissory note from a related party. This means they are relying on others, likely their own sponsors or affiliated companies, for funding right now. And then there is the shareholders' deficit. This is basically saying that based on their assets and liabilities, the value belonging to shareholders is negative $54,122. Again, for a startup or a company in this stage, this isn't the end of the world, but it shows they are currently operating at a loss from an equity perspective. Moving on to how they're doing in terms of making or losing money. This statement covers the period from when they started, the 13th of January 2025, all the way to the 30th of September 2025. Their entire story here is $79,122 in formation. And operating costs, they generated no revenue, which is expected since they haven't made any business combinations yet. The result, a net loss of $79,122. This just confirms that all their activity so far has been about setting themselves up and preparing for future business, not actual business operations. And when you divide that loss by the shares they had, each share represents a portion of that loss, at about 8 cents per share. This next statement shows how that shareholders' equity or deficit changed over time. It breaks down movements like issuing and adjusting shares. We see here the Class B shares issued to the sponsor contributed $144 to the stated value, along with some additional paid-in capital. Then each quarter, the net loss eats away at that shareholders' equity. For example, in the first quarter, a loss of $9,052 reduced their equity. By the end of September, that cumulative deficit reached over $54,000. It really highlights their current state as a company focused on formation, not profit generation. Now let's talk about cash, the lifeblood of any company. This statement shows where their cash came from and where it went. As expected, their operations used up cash to the tune of $54,122. This aligns with their net loss. But look at this. They actually saw a positive cash flow from financing activities, totaling over $59,000. This came from things like advances and payments from related parties, essentially getting money from themselves or their partners to keep things going. This financing inflow is what explains how they ended the period with that $5,000 in cash, which we saw on the balance sheet. It is a clear sign that external funding beyond what they've structured internally is crucial for their survival right now. So what exactly is this company? Note 1 tells us Blueport Acquisition. Ltd is a Cayman Islands company formed in January 2025. Its sole purpose is to combine with other businesses, a business combination. They're an early stage company, and until they successfully buy another company, they won't be making any operational revenue. All their activity since inception has been about getting ready for their initial public offering, or IPO. Speaking of their IPO, it became effective in early November 2025. Then on the 13th of November 2025, they actually sold their units. They sold nearly 5.8 million units, with each unit costing $10. That brought in a significant chunk of cash. And at the same time, they also did a private placement, selling over 197,000 units to their sponsor, Blueport Acquisition Corporation. Also at $10 a unit, this means their own insiders are also investing heavily. But as with any big event, there were costs. Over $2.4 million in transaction costs, including underwriting fees, were incurred. The big money from the IPO and private placement, a cool $57.5 million, went straight into a trust account. This money is set aside and will only be used for their eventual business combination or to return to shareholders if they don't find a deal. This is a critical point. They have a limited time, 15 months from the IPO, to find and complete a business combination. If they don't, they have to shut down and give the money back. It is a race against time. This part is important because they've incurred costs and might continue to, and because they have a deadline to find a business combination, the company is acknowledging substantial doubt about its ability to continue as a going concern. This means there is uncertainty about their future operations if they don't achieve their acquisition goals within the set timeframe. They lack the immediate financial resources to sustain operations for a year without a successful business combination. Note 2 is where they lay out the rules they're playing by for their accounting. They're following United States Generally Accepted Accounting Principles, or US GAAP. They proudly state they are an emerging growth company. This means they get some special treatment and can follow less strict rules for things like executive compensation and audits, which is common for newer, smaller public companies. They talk about deferred offering costs. These are costs like legal and accounting fees related to the IPO that are not expensed immediately, but are spread out or accounted for differently. As of September 2025, they had about $177,000 in these costs. This section is really key to understanding how these special purpose acquisition companies, or SPACs, work. Their class of shares are classified as temporary equity, not permanent equity. This is because shareholders have the right to redeem their shares under certain conditions, mainly if they don't like the business combination, or if the company fails to find one within the time limit. They are essentially setting aside money for potential redemptions. Here, they reiterate the details of the IPO, confirming the sale of 5.75 million units at $10 each. Each unit gives you one share and one right. This right is basically a sweetener. It gives you a small fraction of a share in the future, but only if a business combination happens. This section details the private placement to the sponsor, again at $10 per unit, totaling nearly $2 million. This shows the sponsor's commitment and belief in the company's mission. This is where we see more of the intricate dealings. The sponsor is heavily involved. They issued founder shares, almost 2 million of them, to the sponsor for a very small amount of money. These are the Class B shares we saw earlier. Then, they mention a forfeiture of over 500,000 founder shares. This is a common move in SPACs to rebalance share ownership, often related to over-allotment options. There is a small amount, $5,000, currently owed to a related party. This is likely for early operational expenses, and a larger outstanding amount of over $206,000 on a promissory note from the sponsor. This was essentially a loan to cover IPO costs, and it seems like it was mostly repaid right after the IPO. They have an administrative services agreement paying the sponsor $10,000 a month for office space and support. This is a standard arrangement to cover ongoing operational expenses. This note talks about future obligations. They mention the underwriter's option to buy more units to handle any unexpected demand. This option was fully exercised, which is a good sign for demand. And the underwriters get a deferred fee of $1.15 million, but only if a business combination is successfully completed. This aligns their interests with the company's ultimate success. This section dives deeper into the different classes of shares and their rights. Interestingly, as of the 30th of September 2025, there were no Class A ordinary shares issued or outstanding. This means all the shares sold in the IPO and private placement were still part of units, not separate shares yet. The 1.43 million Class B shares are the ones held by the sponsor, which can convert into Class A shares later. And here is that right again, it is a promise of a fraction of a share, but it is important to note that if the company liquidates without a business combination, these rights become worthless. Now we get to management's own perspective. They call themselves BEPARC, or Blueport Acquisition Limited. They are very upfront, no operations, no revenue. Their focus is entirely on finding a target for that business combination. The only income they expect for now is interest earned on the money parked in that trust account. It is not active business income, just passive earnings on their war chest. This section is crucial for understanding their cash situation. This reiterates that they had very little actual cash on hand and a negative working capital. They are heavily reliant on the IPO proceeds and any further financing or sponsor support. Here, they mention a slightly later deadline than the 15 months mentioned earlier, the 13th of February 2027. This suggests they might have mechanisms to extend that initial 15-month window, probably with shareholder approval, which is a common SPAC practice. They confirm they have no off-balance sheet arrangements. This means there are no hidden debts or obligations that aren't listed in their financial statements, which is good for transparency. They state they have no long-term debt or capital lease obligations, essentially reinforcing that their financial structure is very lean and focused on the upcoming business combination. As a smaller reporting company, they are not required to provide extensive details on market risks. This section is about their internal controls for ensuring accurate financial reporting. Management states that their disclosure controls and procedures were effective. However, they also acknowledge what are called inherent limitations, meaning that no system of controls can be absolutely perfect. There is always a chance for errors or fraud, even with good systems in place. We're now in the second part of the report, which covers other important information. To their knowledge, there are no significant legal proceedings currently against the company or its officers and directors. They refer back to their initial IPO prospectus for listed risks. This means the risks they've already identified remain the primary concerns. They haven't added any new major risks since then. This details those private sales we've discussed, like the founder shares and the private placement units, all done without public registration as allowed for these specific transactions. They confirm again that the main proceeds from the IPO are sitting in that trust account, ready to fund their future acquisition. No defaults to report here, not applicable to this company. No other relevant information to add. This is just a list of all the supporting documents filed with the report, like certifications from the CEO and CFO. Now, let's zoom out and look at the bigger picture for Blueport acquisition. Limited, this company is in the very early stages, almost exclusively focused on its core mission, finding and acquiring another business. They've successfully completed their IPO, which means they've raised a substantial amount of capital and are now a publicly traded entity. The money in their trust account is their engine, and their clock is ticking. The primary strength here is the capital raised, providing them with the resources to pursue attractive acquisition targets. They've also got the backing of their sponsor, indicated by the founder shares and private placements, suggesting a committed team. However, the weaknesses are significant. They have no operational history, no revenue, and a clear indication that they might not be able to continue as a going concern if they don't find a deal within their time frame. The small amount of cash on hand and the reliance on related party transactions highlight their dependency on external financial maneuvers and the success of the acquisition itself. The biggest risk, of course, is failing to complete a business combination before the deadline. This would lead to liquidation, and while public shareholders would get their money back from the trust account, the company's existence would end. There is also the risk that they overpay for an acquisition or choose a poor target, which could undermine shareholder value even if a deal is struck. Looking ahead, the success of Blueport hinges entirely on management's ability to identify and successfully negotiate an attractive business combination within the next year or so. Their next filings will be critical in showing progress on that front. Alright, that is our deep dive into Blueport Acquisition Ltd's latest corporate filing. What is your take on their strategy and their chances of pulling off a successful business combination? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And don't forget to subscribe for more decoding of these essential corporate documents. And if you want to join a community of like-minded investors and get even more insights, check out our Discord channel, linked in the description. Thanks for watching, and see you next time on Corporate Decoder.